Welcome to the 36th installment in Trading Strategy Guides Trading Education Series. Today we're going to look at several different general trading setup types. Stay right where you are. Hi, this is Tim from TradingStrategyGuides.com. Thanks for coming back for this installment of our Trading Education Series. In today's video, we're going to discuss several different types of trading setups. Trading strategies will typically consist of one of these setups or combinations of more than one. Trading is all about finding the highest probability opportunities, ones that offer you a good risk to reward ratio. Using all the different trading techniques presented throughout this course, we can identify different types of trade setups. The most common trade setups can be classified into 5 categories as follows: support and resistance trades, breakout trades, trend trading, range trading, and finally reversal trades. We're going to talk briefly about each one. The general premise behind support and resistance trading is that the price will tend to stop and reverse at these key levels. This is possibly one of the simplest forms to take a trade. All you have to do is follow the steps outlined in our support and resistance module, draw the key support and resistance levels on your chart, and wait for the price to show up at these levels and then jump into the trade. In this example, we're looking at a Great British Pound US dollar 4-hour chart. The best trades are ones taken in the direction of the trend, and since Pound USD is moving in a bearish trend or downward trend, we want to look at resistance areas from where the price is most likely to react and resume the trend. We apply the same rules when trading off of support levels. In this example, we have the USD Japanese Yen daily chart. Here, instead of blindly buying off of support, we can wait for further confirmation until one of our preferred price action patterns shows up. This is a more defensive approach that can confirm your idea of a bounce from support. It's easy to see that this trade idea has produced a substantial bounce off of support. So support and resistance is basically just an area where the price has turned around previously, and now we're expecting the price to do the same when it reaches that point. Generally, what happens is when we have strong areas of support and resistance, the price will react to those areas because most traders are anticipating the reaction and setting their orders accordingly. Support and resistance trading is done with the assumption that price will hold and reverse at the specified price level. Breakout trading is just the opposite. In other words, a breakout happens when a support or resistance level is breached or when the price breaks out of a range zone. If you follow my Trading Picks videos, you'll know that most of my setups involve breakouts from consolidation at a strong support or resistance level. The standard method of trading a breakout is waiting and letting the market break above or below support or resistance levels rather than to anticipate the breakout. So let's have a look at an example. Here the Euro USD comes up to a 15-minute resistance area and tests it a couple of times before finally breaking out. As an entry strategy, we have 2 options. We can simply look for the first retracement, which offers a low risk and high probability entry in this case. Secondly, we could enter as soon as the breakout candle closes, so we don't enter when the breakout happens, as this will help us avoid some of the false breakouts. The principle behind waiting for a retest of the broken resistance is that oftentimes a broken resistance becomes a new support level. In an ideal world, the price structure of any market is governed by this principle. Old resistance becomes new support, and old support becomes new resistance. The downside with breakout trading is that in general they are not low risk, high probability trades because the market is well known for being prone to do lots of false breakouts. A false breakout occurs when our support or resistance level is breached, but there is no follow-through, and the market starts reversing and trading again below the broken resistance or above the broken support. To illustrate a false breakout, here's a Great British Pound USD 1-hour chart example. The price broke below the support level, but the bearish momentum has run out of fuel, and a few hours later we can see the strong rally above the broken support level. As a general rule, if the price snaps back with strong momentum behind, like the case in this example, it only proves that many sellers have been trapped by the broken support and now they are squeezed out of their positions. I often have people ask how to avoid false breakouts. The simple answer is you can't. There's no way of guaranteeing in advance that you're seeing a real or a fake breakout. Trading is based upon probabilities. Once you've satisfied all your rules for the setup, enter the trade. But your rules should include a contingency to keep your loss small in the case of a false breakout. In my case, a candle close above the broken support level is my signal to get out of the trade. Trend trading, as the name suggests, is taking trades in the direction of the trend, up or down. Basically, trend trading is one of the most effective methods of trading. The one particular flaw with trend trading is that when we're not trending, which is the case most of the time, we get a lot of whipsaws. To determine the market trend, we can use the same principles outlined throughout the previous module. In an uptrend, we're looking for a series of higher highs and higher lows, while in a downtrend, we're looking for a series of lower lows and lower highs. This Euro-USD 1-hour chart is a perfect example of an ideal trend trading setup that combines all the market principles, starting from the identification of the trend and ending with spotting a price action pattern to trigger our entry. As a general rule, we only want to buy uptrends and sell downtrends. Besides our trend trading techniques, in order to fine-tune our entries, we can also use our favorite price action patterns in confluence with support and resistance levels. The main advantage of trend trading is that it offers low risk and high probability trade. The reason why trend trading is superior to other forms of trading is the tremendous profit potential that can be made in case we catch a sustained trend. Essentially, range trading happens when the market reaches a point where it's no longer making any higher highs and higher lows, or lower lows and lower highs. It's just going sideways between a defined level of support and a defined level of resistance. The price action is moving between these support and resistance levels. Once you see that type of formation on any price chart and on any given time frame, we've got a range that we can examine a little bit more closely and trade off of the support and resistance level until the range breaks out and gets invalidated. Remember the rule, a range is a range until it isn't. Price will continue to do its thing until something causes it to break out. Sometimes ranges will continue for a long time and give you many trading opportunities. Sometimes they'll break out on the very next touch. Just don't let that discourage you from looking for more range trading opportunities. To define our price ranges, we're going to look for at least 2 price touches of support and 2 price touches of resistance. Once we've identified the range and we have validation of the range, then it becomes a pretty simple matter of just buying at support and selling at resistance. You can make great use of an oscillator indicator in a ranging market to confirm the test of support and resistance and to add confluence to your price action readings. It's important not to get in trades in the middle of the range because you're taking on more risk and the profit margin also decreases. What's important to remember is that the more a level is touched, the higher the risk it will be broken at the next test. Also, be sure the range is wide enough to get a decent profit on your trade. In technical analysis, reversal trading means trading against the prevailing trend in an attempt to catch a top or a bottom, and subsequently the market changes direction. There are many reasons that can be the catalyst for a trend reversal, but the shift in sentiment is given by the supply and demand imbalances or the relationship between the active buyers and sellers. There are several useful strategies that can help you catch a trend reversal. The most common trend reversal strategy is identifying changes in the trend price structure. For example, an uptrend that is defined by a series of higher highs and higher lows reverses into a downtrend by changing the price structure into a series of lower lows and lower highs, and of course just the opposite for a bearish trend reversal. The second most popular reversal trading strategy is divergence trading. Divergence trading is a well-grounded method to spot trends that lack momentum where the price and the market strength are disconnected. The way we accomplish this is by using a momentum indicator like the RSI oscillator and comparing the market swing high and lows with the RSI momentum reading. The basic principle here is that momentum should confirm the trend, so if the market makes a new high, this should be accompanied by a new high in the RSI momentum reading. If the movement of the market price and the movement of the momentum indicator don't agree, we call this a divergence. I typically don't trade reversals, but if I were, I would definitely combine divergences with reversal type price action. I believe these two in combination reveal the highest probability of success with reversal trading. However, reversal trading is one of the most dangerous trading strategies because you're trying to catch tops and bottoms, and that can be difficult. It's like trying to catch a falling knife. If you're successful, you're in great shape, but if you miss, you're going to get cut. The definition of a good trade setup is one that gives you a good opportunity in terms of risk to reward ratio. There is no perfect trade setup because each of these setups works for different types of trading strategies and different trading environments. What we want to achieve here is to pick a trade setup that makes more sense to you and the one that leaves you feeling warm and fuzzy. Remember, develop a set of rules for your trades, follow those rules to the letter, and don't change the rules without thoroughly testing the new rules. And lastly, your mindset is one of your most valuable assets as a trader. So develop the trader's mindset. I'll be discussing the trader's mindset more in a future trading education series video. And that's it for today's video. Next week, we'll be looking at using trend following to maximize your trades. Come back Friday for my strategy of the week and next Monday for my trade pick. And don't miss the next installment of the Trading Education Series next Wednesday when we'll discuss trend following. My videos come out at 3 p.m. New York time on those days. Don't hesitate to ask any questions you may have. Remember, the only stupid question is the unasked one. If this video helped you, smash the like below, subscribe, and hit the bell if you want to be notified of our videos in the future. And by the way, Christmas is just a bit over a week away, so Merry Christmas for all of you who may celebrate that holiday. I just want to let you know that I won't be doing the Strategy of the Week video next week, but I'll be back on the following Monday with the Trade Picks video. However, I recommend that you take the last week of December off from your trading. That's absolutely the worst week of the year to trade. Price just whips all over the place and doesn't do anything logical. I don't recall ever making money on that week. All right, guys, have a great Wednesday, and I'll see you on Friday.